Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very good day in the markets today, and hopefully you're having a very nice week so far. And in today's action, the S&P and the Qs ending higher. However, the last 4 days of trading have been quite volatile indeed. The VIX right now is currently standing around the 20% mark, which is quite high in relation to what we've been seeing over the past few months of trading, and has led to some very volatile moves across the board, especially in some of our favorite growth names out there. Additionally, well, the past 4 days have shown us that there is still some headline risk to the market, with many headlines coming and challenging the narratives of any given day. We have a few to take notice of right here. Number one, we have the good old China saying it will fight to the end after the US said it was trying to hurt the world economy. That was the headline just yesterday. Then yesterday after the close, President Trump, of course, saying the infamous quote at the end of the day, well, maybe we don't need to buy cooking oil from China, and that sent the markets down a little bit into the close yesterday. Additionally, we have the government shutdown entering the third week right now. The longer that this one goes on, the more volatility that could possibly arise, as the Republicans and Democrats just cannot get a deal done, especially surrounding the healthcare situation. A lot of the mandates are going to be expiring towards the end of the year, and that's what currently has them gridlocked. Additionally, we had some big news from Jerome Powell yesterday, suggesting in a meeting that it could be the end of the, essentially, the tightening program, pretty much, to where the runoff of the balance sheet could be complete. I'll remind you, back in COVID, the Fed did their best to backstop the market's downfalls by buying a whole bunch of bonds and a whole bunch of equities. And for the last 3 years, they've been offloading all of that stuff into the market, which does add a bit more pressure against equities and especially against bonds. What Jerome Powell said yesterday is that their runoff is potentially now complete, and the bond market really appreciated that. And last but not least, of course, something on everybody's mind right now. Are we in a bubble? Are we not? Well, some people on Wall Street are saying that we are absolutely in a market bubble, especially because of all of the AI names and all the AI narratives that have been running rampant over the course of the past couple of months. So we have a whole bunch of headlines to cover today. Not only that, we have a whole bunch of earnings as well, because I haven't seen you guys so far, right, this week. In terms of our earnings, we're going to cover a lot of the banks today that reported earnings yesterday, and one that reported earnings today, such as Bank of America. And we also have to cover ASML. So we're going to have a ton of things to do in today's video. And also keep in mind, the Fear and Greed Index is still fearful, despite being at the all-time highs. Friday's shakeout really caught a lot of people off guard, and leading some people to believe that, you know, we might just be due for a bit more of a pullback, even though the last 3 days of trading have showed that the bulls still remain a bit strong. So in today's video, guys, we have a whole bunch of things to cover, of course, right? Number one, we'll be going briefly over those news headlines that we talked about in the introduction. Number two, I got a whole bunch of earnings to present to you guys. We'll be going through them quickly, though. We'll be covering JP Morgan, Goldman Sachs, Wells Fargo, and Bank of America briefly, a couple minutes each. Then we'll do somewhat of a deep dive into ASML earnings that happened this morning, which saw the stock price increase by about 3%. It was 5% earlier this morning, but it kind of tapered back throughout the day, but they were very strong earnings nevertheless. Thereafter, guys, we'll take a look at our normal technical analysis rundown, the SPY, the Qs, and all of our major indexes. See where the rotation is in the market right now. Thereafter, take a look at our big tech names as well. Which of these big tech names are in good buy the dip opportunities right now, and which of them are just a little bit too rich and have ran a little bit too far to warrant our buys. And then lastly, everybody's favorite section, of course, we will be going over the biggest gainers and losers of the day. Of course, we can't cover all of them, but I'll do my best to cover most of them, both to the upside and to the downside, and derive if there's any possible trade opportunities herein. And finally, we'll be going over my portfolio briefly for some trades that I made over the course of this week and which positions I'm keeping into the Friday close. So it should be a very action-packed video, guys. Should be a very fun video. And my apologies for not being here Monday and Tuesday, guys. I was struggling, not gonna lie, man. I was very sick of the Monday and Tuesday session. You guys know me. For me to miss videos in the last 2 years, I think I've only missed like a couple of times, but for me to miss 2 days in a row, something really needs to be happening, right? I had a really bad flu Monday and Tuesday, was pretty much in bed every single hour of those 2 days, except for a couple hours in the morning where I would do the live streams for my Discord members, and then just kind of heading right back to bed. Really bad fever, really bad stomach ache, all that good stuff. Had to go see the doctor and everything, which I haven't done in like 5 years. So thank you for understanding, but now we are back. We're now full of energy. We are good. And we will be doing videos for the rest of the week tonight, Thursday, Friday, and then next week, of course, resuming on schedule. So thanks for understanding. Thanks for your patience. And hopefully you guys have been making it through the markets just fine in the last 2 days in my absence. So we have a very action-packed video today, but I won't be spending too much time on anything. We'll kind of have to catch up through the videos on the rest of the week. So let's get into it, shall we? The SPY up 0.44 today. The Q's up 0.71. Not too bad of a day for the market, but it was a bit volatile nevertheless. You can see here that some of the big tech names were really mixed. Google, Meta, Apple, Tesla holding their own, but unfortunately, Amazon still lagging behind. Despite having very good growth prospects in the future, the market is just not seeing it right now. I think this is still one of the best buys in the market. Microsoft and NVIDIA down a little bit. NVIDIA this morning was actually up 2 to 3%. And they gave almost all of it back and ending, unfortunately, in the red. The banks, a little bit mixed. The credit card players pulling them down and some insurance players as well after PGR reported somewhat lackluster earnings, which saw the stock down almost 10% very early this morning. They did end the day down only 5.78 though. Decent buying opportunity there as well, in my opinion. And the bottom half of the market also somewhat very mixed. If you take a look at the one-day relative group performance, you'll see that even better to where most of the market was moving higher today, but some sectors lagging a bit behind, such as financials were mixed and industrials down a little bit. On the 1 week relative, you can see how mixed and how volatile these sectors have been, right? Energy, technology, cyclicals, industrials, healthcare, and financials, all surprisingly still to the downside. Your outperformers, utilities of all things, make sense though with the power requirements for AI. Consumer defensives getting a little bit of a bid here after the volatility, real estate, communication services, and basic materials. So before we get into the technical analysis portion of the video, we have a few things to cover: the headlines and then the earnings. So number one, the entire China situation, guys. This is going to be predicated on, anything that comes out of the press here in the next few days. Obviously, the deadline is November the 1st. Is there going to be an extra 100% tariffs on China? Is there not going to be that 100%? I guess we will see. There is supposed to have a big meeting by the end of the month. So depending on the outcomes of that meeting, you will have the final number for your tariffs, in my opinion. So no need to speculate that much on these news headlines. I know Scott Bessent said something today saying that 85 senators were possibly approving up to 500% tariffs on China in the event that China would keep purchasing Russian oil. We'll see if that actually happens. President Trump is supposed to meet with President Xi by the end of the month. We'll see if they meet personally or if their two delegations meet together. But as I said, no need to speculate. We'll just have to wait for the headlines. But pretty sure you guys know by now, any and all China tariff headlines will impact the markets moving forward for roughly the next 2 weeks until we get the final results of those meetings. In terms of the government shutdown as well, guys, no need to speculate, right? All you need to understand is the longer that this goes, the more uncertainty that it actually builds and the more damage it could possibly bring to the markets. Now, so far, we haven't really had any market drawdowns as a result of these shutdown headlines. But that could change if this goes on to be one of the longest government shutdowns in history. The longest one so far is about 33 days. Right now, we stand at just about half that, so we'll see what happens with this one too. The biggest news for the markets was arguably yesterday with what Jerome Powell had to say. This is huge, guys. This is the balance sheet runoff. As I was saying, back in COVID, the Fed bought a ton of bonds and a ton of equities to backstop the markets. When they started increasing interest rates, they also started the infamous balance sheet runoff, basically selling back all the assets they bought to backstop the markets in COVID, selling those assets back into the market, all the equities and most of the bonds. Jerome Powell surprising everybody yesterday by saying, you know what? It might just be time to stop the balance sheet runoff. That is very good for the markets, guys. It alleviates some pressure that's been afflicting bonds recently. And also the equity markets can take that in stride as well. So this was a very big piece of news, right? You could argue that it is even somewhat of a soft rate cut because obviously there's two parts to the Fed. There's the whole quantitative easing versus quantitative tightening battle, which is this right here, right? It means that the tightening essentially is kind of winding down. We're not going to easing because that would be them buying again. They're just done selling essentially, right? And then part number two is the whole rate cut cycle. I'll remind you, the rate cut cycle is still kind of set in stone right now. Probabilities for rate cuts still stand at 25 basis points for the end of the month of October. Some people have been calling for a 50 basis point cut, but that's not what the market is pricing in. There's going to be 1.25 at the end of October and then one more 0.25 in the month of December. Those are the odds right now, but this was a very big piece of news and could help bolster maybe some of the longer term bonds and maybe a soft form of longer term yield curve control as well. And then our final piece of news, this one right here. And we're going to talk about this not only in today's video, but in most videos moving forward, because I'm pretty sure it's front and center on everybody's minds, right? There was a survey that came out yesterday by Bank of America, which is polling a lot of investment managers. Do they think the markets are in a bubble? Okay, let's see what they had to say right here, right? Absolutely a market bubble. Wall Street sounds the alarm on AI-driven boom as investors go all in. Obviously, guys, it's because of all the open AI deals that have been coming out recently. I was telling my Discord group this morning, we've had an AI bull run for the most part for, let's say, the last 2 years. But only recently has it kind of gotten turbocharged with OpenAI striking billions of dollars in deals. As a matter of fact, $1 trillion worth of purchase obligations with money that they don't even have right yet, right? So that being said, and all these circular deals between NVIDIA, Oracle, OpenAI, AMD, et cetera, right? It's starting to raise some questions whether or not all this spending is actually warranted. Is it justified? Where are the efficiency gains? Where are the revenue gains from all of this? When will we see them? All very normal questions. So let's see what Wall Street had to say on this matter. Here's what Jamie Dimon had to say. After months of record gains in AI-linked stocks and corporate spending, concerns are mounting that the boom is starting to look like a bubble. JP Morgan CEO Jamie Dimon underscored that the tone of caution while speaking to reporters on Tuesday on his earnings call, calling elevated asset prices a category of concern. When asset prices are elevated, you have further to fall, said Dimon, adding that while consumers are still spending and companies are making money, which is true, valuations and credit spreads remain stretched. You have a lot of assets out there which look like they're entering bubble territory, he said. That doesn't mean you don't have another 20% upside to go. It's just one more cause of concern. So Jamie Dimon has been very firm on this. He said this many times. You can even just Google Jamie Dimon AI bubble and you'll see exactly what he had to say. He says that some stocks are possibly entering AI bubble territory, but not everything. He still seems to believe that, he believes that AI is still very good for the markets. Yes, it will displace some labor temporarily, but overall the efficiency gains and productivity gains will actually be real, but they will take some time to materialize. So those were his comments. Moving on further down here, here's what the rest of Wall Street had to say in this Bank of America survey. Now, citing the equity AI bubble, of course. The survey, which polls roughly 200 fund managers overseeing nearly $500 billion in assets, showed cash levels falling to 3.8%. That is near Bank of America's sell threshold of 3.7. Basically mean when people are so low on cash, they're too bullish, and that sometimes can lead to a correction sooner than later. Historically, readings below 4% have marked periods of peak risk appetite, often surfacing late in the market cycle. Before Friday's sell-off, actually, as a matter of fact, we were kind of neutral. A month ago, we were in greed. Not all things are firing on the greed cylinders at the same time, though. So keep that in mind. The optimism showing up in institutional position, that optimism is showing up in institutional positioning data too. State Street's Risk Appetite Index shows large professional investors, or so-called big money, entered the fourth quarter as bullish as they've been all year, adding to riskier assets for 5 straight months. Absent a very large shock, it is unlikely that they will change their views soon. Another early warning sign, correlations across sectors have fallen to their lowest since the current bull market began. Colas says that these unusually low readings tend to appear when investor confidence runs too high and is a pattern that often precedes short-term pullbacks. What do these two things mean? I'll break them down for you guys. First, the correlations, right? And then above here, in terms of adding to riskier assets for 5 straight months. Well, I'm sure you guys have seen the usual suspects on the highs. Now, some of these are recent thematic plays, such as the critical minerals plays after, they began when there was the initial tariff threats against China and the willingness to move away from critical minerals from China, right? The MP materials of the world, the ABATs, the USARs, the quadruple Us, all of which have ran to arguably very rich levels in terms of their future production capacity for the next 3-4 years. Then you have other aspects of the market like the nuclear plays. None of these companies have any revenues to show whatsoever until 2028, but it doesn't matter. It's all about the sentiment. It's all about the hype, isn't it? There's those names. Then, of course, we can bring up the neo cloud providers, which everybody loves so much, the NBISs of the world, the Iris Energies of the world. Fantastic companies, don't get me wrong, but now all trading at somewhat lofty valuations. And then, of course, you have the energy companies such as Bloom Energy that nobody can get enough of right now, rallying ridiculously. I'm not complaining. I'm just pointing to the assets that people like Jamie Dimon and other money managers may say that are in bubble territory right now, because the fundamental numbers have long since decoupled from the actual stock price of the company, right? This is all hype. This is all momentum. This is people pulling forward revenue numbers that could only be seen in 2028, 2029, and 2030. However, the entire market is not in bubble territory right now. As a matter of fact, we will do the breakdown later. Most of all your big tech names, which is, let's be honest, like 35-40% of the entire weight of the S&P, most of those names are trading at relatively okay multiples. And then you have other aspects of the market that just haven't done anything for the last few years. Look at healthcare. What has healthcare done for the last 4 years? Nothing. What has consumer defensives done for the last 4 years? Nothing, right? What has real estate done for the last 4 years? Arguably nothing as well. So several aspects of the market are still, relatively fairly valued. And I'm not even bringing up consumer discretionary firms. Consumer discretionary firms have been in a recession, arguably, for the last 2-3 years. So it's only certain aspects of certain tech names specifically, right? And a lot of that's only happened over the past month or two. Names like LRCX that were not performing the best, now having the exponential moves, right? Names like TSM, which were on a normal growth path, now finally getting the exponential push. Names like Micron blasting off to the highs. Even names that were lagging behind, such as ASML, finally catching up. Now, some of those names fundamentally are not that overvalued, especially not when comparing to some of the smaller ones like the EOSEs. You guys probably know these, right? The EOSEs of the world, the APLDs of the world. You guys know what companies I'm talking about when we're talking about stocks that are just running more and more and more every single day. The CCCX, anything AI, right? If it's not AI, and I've said this time and time again over the past month and a half, if it hasn't been AI, it hasn't been working. That's just basically been the market outlook for the past, I don't know, let's call it a quarter or two at this current time, right? Some of the software plays that are currently being afflicted by AI. Look at some of these enterprise software plays, solid companies, right? Where's Salesforce? Well, apparently AI is going to just destroy their business, right? Where's ServiceNow? That hasn't done anything for the past, year at this point in time? There's ups, there's downs, but no expansion in share price whatsoever. So there's whole aspects of the market. Look at Adobe. Where's Adobe? Just left for dead. Pretty much AI is going to swallow their entire business, I assume, right? So the entire market is not in bubble territory, but a few key names are indeed in bubble territory. And that's what you kind of have to watch out for. That is the exuberant portion of the market that everybody wants to chase more and more and more and more. And if we do have a correction, those are the aspects of the market that will pull back the hardest. But does the market have some safe zones? Zones of the market that are fairly priced that it can rotate into? Yes. And as Jamie Dimon was saying in his quote, are there certain aspects of the market that are, fairly valued? Absolutely. And he did say consumers are still spending and companies at the end of the day are still making money. GDP is still strong. The labor market is okay. Net new job creation as measured by the ADP jobs report or the non-farm payrolls. Net new job creation is not the best, but are businesses hemorrhaging jobs by the millions? The answer is no. GDP is still fine. Is it being propped up by 0.4% worth of AI spend? Sure, but that's not the entirety of GDP, right? So that being said, not everything is bad in this current market. Earnings are still good. But, I will leave you guys with this, right? I will always remind you, I don't say this often, so I may as well just say it once, right? The market does not crash because you are quote unquote in a bubble. It's not just going to one day wake up and say, listen, we're in a bubble, we're going to crash. No. There are going to be catalysts to the crash, whether those catalysts are tariffs, whether it's jobs, whether it's macro unraveling, right? Macro unraveling, things of that nature, like manufacturing index, services PMI, things of that nature. Things are going to start to happen. And then the bubble narrative is going to be the fuel that adds to the downside selling pressure. Because when people start selling, they'll refer to this. They'll be like, you know what? we were in a bubble. So yeah, maybe we can fall further, and they'll just keep selling, right? Because this is the narrative that the media has been building up and building up and building up. The amount of bubble mentions in the past 30 days, guys, is rivaling the dot-com era. The S&P and the QQQs are nowhere near dot-com era levels in terms of forward price to earnings. I mean, the NASDAQ back then, guys, was trading at like a 50, 60 earnings multiple. It's nowhere close to that right now. It's about, less than half of where we're trading right now, essentially. So we're nowhere close to that. But this narrative is what is going to add fuel to the fire that will be started by a catalyst. Now, the trillion-dollar question is always what is going to be the catalyst, or what is going to be the straw that starts breaking the camel's back. And that's what we have to pay attention to. If you ask me my best guess, the narrative right now that would make the most sense would be jobs, because that is the biggest concern. That is the Fed's biggest concern. If the jobs market starts unraveling and the Fed has to do a jumbo cut, a 0.50 when the market's expecting 0.25, that's a fear-driven cut, and that will definitely spook the markets, and then we'll start unraveling down, and then people will start talking about a recession, and then people will start saying, well, the AI spend was overdone, the company spent too much, there it goes, we're done, and then you just know the snowball starts rolling, right? So that is how you should view these things. Stay alert and do not be greedy in these markets. How do we not be greedy in these markets? Well, by doing things like this, right? If I have a leap on Google, this is a real example. If I bought a leap on Google down here and I closed at my take profit at 250 and I locked in all those gains, can we please not double dip with more contracts? Can we please not just go like, let me do a little bit more. Let me just get back in here with more contracts, because obviously it's a raging AI bull market, right? Let me just get in with more contracts at unfavorable risk reward, and let me go for the absolute moonshot, the greedy moonshot with double the size, right? If I take a trade on Micron down here and I close it at my profit target up here, another real world example, this is my trade, right? Can we please not double down up here with more contracts saying, you know what? I'm going to go for the absolute moonshot, because why not? Okay. If I make a whole bunch of money on Iris Energy, buying it at $24 after earnings, after watching my earnings video saying it's a good deal, and I make a ton of money here, and I close here, and I see it run here, can we please not get back in here and say, oh, I can't miss it. It's obviously going to 120 bucks. I sold early. Can we please not double dip? Don't double dip. Don't get greedy. Lock in your gains. Be happy with your trade and move on to a next one with favorable risk to reward. That is the takeaway that I will leave you from all those news headlines. Now, shall we move into earnings? Let's get into it. Let's do the banks first. No, you know what? 2 more minutes, because I really want to drive this point home. SOFI, one of my favorite stocks, right? Can we not double down? If we made a bunch of money riding SOFI here to here with call options and things of that nature, is it time to, if we've taken some profits, is it time to double down with even more contracts up here when the risk reward is unfavorable, thinking, well, I'm just going to ride it from 28 to 40 at this point? You cannot do it with the same size, guys. The risk reward here is very favorable. The fundamentals are very favorable, and the momentum has not come. If you're taking that same trade up here with the same size, you're just asking to possibly get steamrolled. That being said, I love this company. Robinhood, same concept. Can we please not double down? If we've made a whole bunch of money on Robinhood from here up to here and we closed, can we please stop getting FOMO and wanting to position with the same size as down here with favorable risk to reward, and taking that same trade all the way up here with unfavorable risk to reward? It's just not worth it type of thing. The critical minerals plays. If you guys missed them, you missed them. Several people were asking me recently, well, you were talking about it down here. I didn't buy. Can I buy it up here? Guys, like, what are we doing? Seriously, what are we doing, right? Please don't do that. The risk reward was very favorable down here. Now, I'm not saying it can't work. Of course they can go higher. But is it favorable risk to reward? Can you commit the same size to those trades? No, you can play them, but you have to play them with reduced size, right? Same concept, right? These critical minerals plays. Yes, it's a nice narrative. Yes, it's a nice niche, but these companies, you need to understand, right? If you're a critical minerals player, a lot of this demand will not happen before 2027, 2028. You're pulling forward a lot of future growth right now. So those people that want to do the short-term call options, can it work? Can you get lucky and get a nice further 10, 20% pop? Sure, but is the risk reward as good as it was down here? No, people are offloading into you right now. All these guys with massive gains are offloading into you. The poor person who unfortunately sees these charts and sees this narrative late and just wants to participate because you absolutely have to get a piece, guys. Don't think like that. That's the FOMO talking. That's the greed talking. There's many other plays in the market. There'll be many other narratives. If you can find the narratives early, take this as a learning lesson, right? Find the narratives early. And when you can find them early, that is when you can position a bit more heavily because the risk reward is favorable. When the risk reward turns unfavorable, that's when you have to either not trade them or severely reduce the size of the positions and have a tighter stop loss. Now we can move into our earnings segment, shall we? So we're going to start off with the banks, guys, and I'll be doing a very quick rundown of these because if not, we're going to be here all day. So let's just cover the big players first, shall we? So JP Morgan, I'm just going to say this front and center for all these earnings. The banks, guys, they absolutely crushed it. Absolutely crushed it. But we've been saying that for the past 3-4 quarters, right? Net interest income is up. Consumer spending is still strong. Credit cards are up. Debit cards are up. New consumers for the banks are up. Everything's doing fairly well. But we know that trading revenues are also way higher because of the direction of the markets, right? In the last 2-3 quarters since the tariff lows, trading revenues are way, way, way up. But you guys know that already. Everybody was expecting that. But what you want to derive from the bank earnings is the same thing that we've been looking at for the past 2-3 quarters. The concern has been the consumer, right? The narrative circulating right now is that the consumer is tapped, absolutely tapped, resorting to credit and not paying their credit cards and not paying their other obligations. And supposedly there's a massive commercial credit bubble as well. Is that the case? And can we see that in the bank's financial statements? So those are the things that we'll be paying attention to during these earnings reports. We'll be going over the beautiful numbers as well, but we'll pay special attention to those credit metrics from the banks because they're very important, guys. These are the biggest banks in the country, right? So first off, JP Morgan. JP Morgan Chase tops estimates as trading revenue hits a record of nearly $9 billion. Is anybody surprised? The markets have been booming recently, right? Smashed it. Absolutely smashed it. Beat on EPS by 4.63, beat on revenue by about 2%, which is good for JP Morgan. They're a massive bank. Keep that in mind, yeah? So fixed income trading, 21%. Ridiculous. Equity trading, 33%, equally as ridiculous. Investment banking fees, 16%, makes sense. A lot more mergers, a lot more acquisitions, a lot more IPOs. So investment banking fees doing really well. A lot of very large customers having their money managed by the bank too. And the bank generating those juicy fees. Here's what Jamie Dimon had to say. While there have been some signs of a softening, particularly in job growth, notice he did not say layoffs. He said job growth, which is what we've been saying on the channel for the past 2 non-farm payrolls reports. The U.S. economy generally remained resilient. You got to trust him when he says that, right? But here is when the executive banker comes into play, right? However, there continues to be a heightened degree of uncertainty stemming from complex geopolitical conditions, tariffs, and trade uncertainty, elevated asset prices, and the risk of sticky inflation. As always, we hope for the best, but these complex forces reinforce why we prepare the firm for a wide range of scenarios. Essentially, he's doing his job by issuing these statements. It's been 3-4 years that I've heard Jamie Dimon say anything bullish about the economy on an earnings call, because that's what he has to do. That's how he gets so much assets for the bank, right? In times of great uncertainty, JP Morgan has your back. Your money is safe with us and our investment managers. We will help you navigate the current situation. Now, Jamie Dimon is a very honest person. He calls it how he sees it. That's why I love him. That's why he's one of the best CEOs on the planet, arguably. But these little risk disclaimers are kind of hand in hand with, his job, essentially, right? But he did say as well that the consumer remains fairly resilient. JP Morgan's provision for credit losses rose 9%. Which the firm is preparing for higher loan defaults down the road. So they're just being a bit careful. Now, this is funny because when we take a look at Wells Fargo and Bank of America, they actually did the opposite. They actually reduced the provisions for credit losses. Now, 9% isn't the largest increase, but it is a bit of a protective measure by the US's largest bank. If we take a look at some of the credit measures by the bank, you'll see that a lot of them are just very solid, right? In terms of common equity tier ratios, which is a liquidity ratio for the bank, very, very, very solid. Minimum industry requirement is roughly around 9-10%. They're sitting well above here at about 50% above the requirement, which is very, very, very solid. Return on total tangible common equity, 20%. That's one of the best banks metrics for internal rate of returns, essentially, on investor capital and on the bank's capital itself. Very solid, 20%, extremely solid. But everybody wants to know about the other metrics, right? So if you take a look here, guys, at the liquidity ratio right here, the LCR, 110%, which is above the industry standard, all the same. If we take a look, though, at some of the consumer credit reports, both with, wholesale or rather commercial banking and also consumer banking, net charge-offs, $1.9 billion. So the net charge-offs of roughly, they say they rounded up to about $2 billion. That's up $44 million year over year. Not that big of an increase whatsoever, primarily driven by card services. That's all good, but what does it translate to, Will? Don't worry, I got you. Card services net charge-off rate. Are people defaulting on their credit cards left, right, and center because they are tapped? Is it an increasing thing? No. Last quarter was 3.4. We're currently sitting at 3.15. And last year, in the same quarter last year, 3.24. So we're lower this quarter than we were a quarter ago, and we're lower this quarter than we were a year ago. So is the consumer that tapped? Is credit running away from us? Are the banks just going to collapse under the burden of all these charge-offs? No, right? I don't think so. In terms of the commercial banking bubble, right? All these commercial clients just can't pay their obligations. They're going to default on all those buildings, right? Well, the bank has $1.4 trillion in loan obligations. How many commercial charge-offs are there? $567 million only, right? So, and this appears to be related to borrower-related collateral irregularities in certain secured lending facilities. It's a very fancy way of saying, listen, it's isolated to a few clients here and there who possibly got unfavorable loan terms, and now with the change of interest rates and refinancing requirements, are just not able to possibly refinance their buildings, so they unfortunately have to have their buildings repossessed by us. That's a fancy way of saying that, right? And a net reserve build of a whole whopping $242 million only. That's not very much, is it, right? So much for the commercial banking bubble as well. So JP Morgan, well capitalized and smashing all relevant metrics. Definitely no credit, red flags here. And trust me, guys, I will be the first to admit when there are, but so far, not much. Moving on to Bank of America. Bank of America tops expectations on 43% surge in investment banking revenue. Stock today was up around 4%. Solid. Did they smash it? They crushed it. 11.38% beat on EPS and a 2% beat on revenue as well. These metrics are ridiculous, man. Second largest U.S. bank by assets said profits rose 23%. Revenue up 10.8% from a year ago. It's a bank pumping out double-digit growth on profits and revenue. Those are big numbers, guys. Investment banking fees, 43%, ridiculous. Equities trading, 14% rally on revenues, beating the estimates by $200 million. Fixed income trading, only 5%. Those bond traders need to do a better job. Bank of America also benefited from an improved outlook around credit losses in the quarter. The company said its provision for credit losses fell about 13% to $1.3 billion, which was below the $1.58 billion from the street. That was the street estimate. So JP Morgan raising, Bank of America dropping. Wells Fargo as well dropped, and Citigroup as well, by the way, dropped as well, but we won't be covering them today. Citigroup. Net interest income rose 9%, the biggest metric for the bank, of course. And Brian Moynihan said that with continued organic growth, every line of business reported top and bottom line improvements. Very solid, but that's all good. That's all fun and games. All the trading revenues are higher, more customers, more cards, more everything, right? You'll be able to see, right, more loans. Take a look at the consumer side of things, right? Consumer banking was not doing too bad. Global banking still on the rise. Those are all good. But what we really want to know is the bank well capitalized, and what's the credit situation? Well, number one, take a look at the net charge-offs here. Lower than last quarter. Not too bad, right? Lower, 1.4 billion as opposed to 1.5 billion. In terms of a reserve build or release, you actually have a release here of $100 million, which is not too bad. So apparently Bank of America is not very much worried about the creditworthiness of their clients, right? That being said, in terms of the CET1 ratio, very decent, above industry standard as well. So not too bad there. If you take a look down below here, I'm going to run you guys through a few credit metrics. Net charge-offs, here we go again. Where is the trend? Is it down or up? Consumers are tapped, right? People must be pouring more into their credit cards, and they can't possibly be paying off their credit cards and or car loans and or mortgages, right? People are tapped. Nobody's paying anything off. The economy's crashing, right? Not so much, guys, right? Don't think in extremes. Just be very logical and just look at the data, right? They'll tell you these guys have almost all the clients in North America, right? So that being said, net charge-off ratio is actually going down, and it has been trending down for the last 5 quarters. You can see that right here. This is a cumulative rate. If you want to see the total rate, you would have to go all the way over here. Credit card charge-off rate of 3.46%. That was down from 3.82% last quarter. So you can clearly see the trend is down, and as a result, their provisions, the amount of money that they put aside for people who don't pay their debts, has been going down. As you can see right here, they break it down even further. Consumer net charge-offs, because this is total net charge-offs. It includes everything, but just for consumers here, because this is consumers and commercial, right? So consumer down. As you can see, the trend has been coming down over the course of the last couple quarters. That is very decent. Now, if you take a look at commercial, which is what everybody's concerned about as well, up or down? Well, last quarter had a bit of an uptick, but now we're kind of back to the same 0.23 that we've touched a couple times over the course of this last fiscal year as well. So not too bad at all. So another bank showing you that, yeah, the bank is well capitalized to withstand anything that the market may throw at it, but also are its consumers paying back their loans on time and are their charge-off rates looking decent? Well, the answer to that question is, yeah. Moving on to the next bank. Wells Fargo tops profit estimates, raises return target after the asset cap was lifted. Yes, something the Federal Reserve allowed them to do just about a month and a half ago. Wells Fargo Corporation reacting very nice to that news. They were up 7% yesterday and another 2.25% today, meaning they can onboard more clients. That's what the asset cap being lifted means, right? Because they were held at an asset cap. The Fed didn't want them to take on any more loan positions and whatnot. They were held to that cap for the last few years. That was now lifted by the Federal Reserve. So very nice move right there. Healthy loan growth. The bank is targeting 17 to 18% return on tangible common equity. You remember that metric that we were looking at for JP Morgan, their highlight metric, right? That's one of the highlights that a lot of the banks use. You can see JP Morgan's right here is 20%. As I was saying, it's the best metric to get a sense of whether or not the bank is utilizing its capital properly and returning that to not only itself, but also to shareholders through various things, but mostly through returns to common equity. You can see here that Bank of America's is 15.4%, and now Wells Fargo was averaging 15.2%. They've raised it to 17 to 18%. So that's one reason that the stock was trading higher. But another one was that their cap was lifted, so now they can onboard more loans. Moving on further, here's what some people at Wells Fargo had to say. While some economic uncertainty remains, the U.S. economy has been resilient and the financial health of our clients and customers remains strong. Getting a theme here, right? And they should know because they see the financials. They see everybody's financial statements. They see the inflows. They see the outflows. They see how much loans you have, and they definitely see whether or not you're paying those loans back. And trust me, the banks, they don't care. They would definitely say if there were any problems. They told us back in 2022, in early 2023 as well. You remember the small and medium regional banking crisis in 2023? They didn't mince their words back then. They definitely said, yeah, it's not looking the best right now, right? And now they're saying, no, listen, everything right now is not as bad maybe as people might think. Strong credit quality. U.S. consumers continue to spend money and repay their loans on time, reflecting strong credit quality. Still, uncertainty looms as the labor market is showing signs of softening. Credit performance was strong and continued to improve. Spending on debit and credit cards continued to increase. The bank set aside $681 million as a provision for credit losses in the quarter, compared with $1.07 billion a year earlier. So them too, reducing the amount of money in reserves for possible credit losses. So Wells Fargo down, Bank of America down, JP Morgan up. So I guess it depends on the bank, but overall, even JP Morgan wasn't that big of an increase, but you can tell by the net charge-off rates, right? They're really not that bad. They're actually trending down. Investment banking shines for this bank as well. Global deal making surged past the $3 trillion mark for Wells Fargo, 33% surge in U.S. mergers and acquisitions volumes. Very strong. Investment banking fees jumping 25%, which was absolutely ridiculous. And investment advisory fees and brokerage commissions were up 6%. So all lines of business for the bank performing very well as well. That is it for Wells Fargo. And last but not least, I was telling you, we're going to run through these quickly. If not, I'll be here all day. Goldman Sachs. Goldman Sachs, after their earnings, what's funny is they actually dropped somehow like 5%, but they absolutely smashed it. They're kind of back right now. They haven't dropped too much. they absolutely crushed it, guys. Goldman Sachs crushed it. But keep in mind, right? JP Morgan, they dropped after their really good earnings. They popped back above again today. But keep in mind, right? These guys are outperforming the S&P. 26% year to date, 27% year to date on JP Morgan. And Goldman Sachs, even better, right? Goldman Sachs up 32.5% year to date. And we're not even at the all-time highs anymore, right? So that being said, big time outperformance, big market leaders in financials, of course. So you kind of got to justify that performance, right? You're not expecting these banks to, even after these record profit numbers, it's a stretch to anticipate that they would be up 5 to 10% immediately after their earnings. We'll see where they end up by the end of the year. There's definitely no red flags to pull these banks down, 20% in some form of a correction. The numbers are not bad enough for that, of course, unless the overall market falls into some sort of a negative narrative, of course, right? But they have been having some pretty big outperformance. So, I'm not saying that they won't just continue to move up. That is very possible. But after earnings, kind of like we saw last quarter, right? Even though companies can have really good earnings, if they've outperformed a lot, especially leading into earnings, maybe they just might not react to earnings the way that you might anticipate, even on good numbers. But I digress. Goldman Sachs, strong earnings, yes or no? Crushed it, man. Crushed it. EPS, 11% beat and a 7.5% beat on revenue. That is not small. That's very, very big. So here you go. Goldman Sachs beats estimates on better than expected investment banking, obviously, and bond trading too. But their equities traders lagging a bit behind, unfortunately. So we're going to have a talk with them. Investment banking was the engine for Goldman's beat this quarter, with fees jumping 42%. Ridiculous. Investment banking activity, including mergers and IPOs, has also gained steam, with the industry's revenue climbing 22% in the third quarter. Strong. Fixed income trading revenue rose 17%, but the bank's equities traders producing only 7% increases in revenues. Maybe they should take a page out of Wall Street Bets' book and just start continuously bidding up the same companies over and over and over that are trading at ridiculous multiples right now. Maybe they would have better chances of beating some of you guys, possibly. I'm not saying that you guys do that, but you know what I mean, right? I'm kind of just making a blanket statement. I'm not saying that you guys trade like that. Some of you guys might, which is fine as long as you're not doing it with the entire bag, right? But Goldman Sachs, I digress, very strong earnings report from them. The bank coming down. If you ask me which of these two players of the four that I'd named recently could have some very nice increases, shortly, the ones that I like the best in terms of technical setups, I mean, they are trading somewhat rich, but I like Goldman Sachs. Very nice breakout retest here right in the 12 EMA for possible further appreciation. Tom Lee has said this many times as well. They'll be having some macro. They'll be having some tailwinds from migrating their backend from the old SWIFT terminals and interbank fees and interbank foreign exchange fees to blockchain, right? On the Ethereum networks. They're building out the backend right now, which will save them a bunch of money at the same time too. JP Morgan and Goldman Sachs are front and center in that pivot to the blockchain. So that's a bit of a tailwind, but also the very strong numbers, right? So if you ask me which ones look like the better technical setups for maybe some breakout trades, I like JP Morgan and I like Goldman Sachs. And those are my takes on the banks. Strong earnings, no red flags, decent consumer credit metrics as well, and the banks are indeed well capitalized for anything that you might throw at them, whether it be consumer credit concerns, commercial credit concerns, both of which are not the case right now. But if they were to somehow come to fruition, do the banks have enough money, right? Are they in a good enough financial position to absorb? The answer is yes. What might get hit the hardest in the event that that does happen? The small and the regionals, but definitely not the big boys. They are too well capitalized at this point in time. And that's everything I had for you guys for the bank earnings. Hopefully you guys enjoyed. Now, before this video gets to be 2 hours long, I mean, I haven't seen you guys, right? There's so many things to catch up. That's my fault though. Well, I mean, I was sick, so my bad. ASML, let's cover ASML earnings right away, shall we? So ASML earnings, good earnings, great earnings. But the problem, guys, into earnings from September, the stock was up, what, 47%? So it's like, how much more can you actually want? How much of this was actually priced in? You would probably argue a decent portion of it because it was lagging behind so severely. I don't know how many times on the channel over the past year, I was saying, ASML might be a decent long-term buy down here, might be a decent buy, solid company. They have a pretty big moat, pretty big competitive advantage. Not many people do what they do. Right? And it was kind of just, yeah, well, it's not that sexy. It's not as sexy as AMD or NVIDIA or maybe Micron or maybe some of the other plays. It's just not as sexy. It hasn't been moving. Well, and then it just moves all in one shot in 1 month, 50%, right? Isn't that always how it goes? Shout out to Google, kind of did the same thing over the past month and a half, right? That being said, on to ASML's earnings. They had a very decent quarter, and I'll just leave it at that. Decent. Nothing crazy, but also nothing very bad. I'll remind you what happened last quarter, right? The stock dropped like 10% because the CEO said, yeah, like we have a lot of AI demand, but we just can't confirm any growth for 2026. Sorry, we probably will have growth, but we just can't confirm that we will. You know what I mean? And it was just like, what? What is this guy even saying? Anyways, that was pretty much put to rest today. So that's why the stock was up about, it was up 5% earlier, but at the end of the day, up only 3%. Decent quarter for ASML. Nothing crazy, but decent. A lot of the big numbers going to come end of next year into 2027. But the pipeline is what counts the most. Is the pipeline full? Ooh, the pipeline is more than full, guys. EPS beat 0.41, soft, revenue down 3.17, but we've been over that before. ASML has very lumpy revenue streams, and I'll explain why, right? They sell very big machines for the most part. Sometimes, depending on whether the companies that they sell these machines to, the foundries, right, whether it's the memory aspect, which they'll be selling companies like SK Hynix or Samsung or Micron, or if they're selling their lithography machines, the players there would be something like maybe an Intel or something like a TSM or also something like a Samsung, right? Depending on whether those companies, the end destination companies, are ready to receive those deliveries, well, that's going to impact ASML's ability to deliver those machines in a current fiscal quarter. Meaning the ASML might plan to deliver, I don't know, here's what it says, right? $9 billion worth of machines. But if only a few players say, yeah, can you hold that off? Our installations aren't really ready to just have the new machine in place for us yet. Can you hold it off for a quarter? Like, we're still taking the machine. Can you just hold it off for a quarter? Well, then they have to remove every one of the biggest machines, right? They're like $400 million. So you just delay one of those and you'll miss earnings. You know what I mean? So you got to take these revenue numbers with a bit of a grain of salt. The money in the pipeline is obviously the more important metric for ASML. It just goes to show you more in terms of, is there actual demand still for this company and what it does? And obviously the answer is yes, because not many people do what they do. But that being said, for the introduction, let's move into the ASML easy numbers. You'll see here that revenue is up only 1% year over year. Net bookings, though, the highlight, I'll remind you, 105% year over year. That was very strong. That is what the CEO could not confirm last quarter. He was saying, yeah, the net booking should probably be solid, but we're going to wait an extra quarter to tell you guys the actual outlook for those. So net bookings were very strong, and he did confirm that 2026 will be a better year than 2025, but not as good as 2027. So still kind of leaving the door half open there. Operating margins were down a little bit as they invested a bit more money into CapEx and R&D. Operating income only up 1% and EPS up 4% year over year. So as I said, it was an okay quarter for ASML, but did they lay all the concerns to rest? Absolutely. Moving on to some of the earnings highlights here, ASML looks to calm fears over 2026 growth as it warns of China's sales decline. But we knew this already. This is not new news. This comes from the export restrictions that have been in place all year pretty much, right? And it does represent a decent portion of their business. Here's the portion of their business, right? So as I said, they do a lot of different things, right? They do their advanced lithography machines, which are the massive machines that you guys know. These machines real quick, right? So you guys know these monster apartment buildings worth of a machine, right? These massive machines right there. That's a portion of their business, but they also do some smaller stuff in relation to memory, which companies like, Micron use, or like other things of that nature, right? Even metrology and inspection for some companies like, LRCX or, Applied Materials, et cetera, et cetera, et cetera. That being said, two divisions of their company, but in terms of the breakdown, right? You can see that 42% does go to China. They don't get the best technology, but they do get some technology. And then 30% to Taiwan, obviously for the big boy, Taiwan Semiconductor, and to South Korea, namely the large player, which is Samsung. Shout out to SK Hynix as well, will be involved in this breakdown of all those two. So that being said, this is the concern, right? The concern that China shipments will be going down a little bit. And the CEO was just saying, listen, they're going to be a bit lower, but we're going to be able to make the rest of that up with the rest of our sales pipeline. So let's move into it, shall we? Guidance was key for the firm after shares sank in July when it warned that while it would still prepare for growth in 2026, it could not confirm it at the time due to increasing macroeconomic and geopolitical uncertainty. That's what I was saying earlier, right? The CEO basically sandbagging himself, which was surprising. On Wednesday, the firm said it does not expect 2026 total net sales to be below 2025. So that's good, right? Initially, he was saying, yeah, I can't confirm any growth in 2026, meaning the numbers for 2026 versus 2025 would be exactly the same. That's not very good. Now, finally saying that, yeah, total net sales would not be below 2025, so they'll be above. But he did leave the door half open, as I said earlier, right? They'll provide more details on the outlook in January. So once again, the CEO just teasing us, man, holding too much back. Very unfortunate, but it is what it is. It also maintained its forecast for annual sales to increase around 15% this year in comparison with 2024, with gross margin of around 52%, which has been relatively average for the company recently. The company continues to benefit from the AI boom, with investments helping fuel orders of $6.28 billion in the third quarter, which is what we said here, that 105% year-over-year gain. Very strong, a lot of money in the pipeline still. But the firm expects customer demand and sales in China to decline significantly next year compared to 2024 and 2025. So next year, maybe a bit of a transition year for ASML, and the numbers for that look a little bit like this. So here's what he means, right? 2025, great. 2026, it's okay. It's a baby step. But then 2027, 2028, big year for the company, right? Or big 2 years for the company. So that's what he means when we're talking about all that stuff down there. Moving on further, we also see that AI could create a lot of value in our products moving forward. So we continue to see a very strong opportunity on our technology roadmap. Obviously, market participants accept that next year will be a low growth year for ASML. An earnings report from ASML's biggest customer, TSMC, due on Thursday, will be a key as crunches in computing capacity and AI infrastructure are expected to continue to increase demand for ASML's advanced lithography systems. Obviously, TSMC is one of ASML's largest customers. I think that TSMC will be saying the exact same thing that they've been saying all year. Demand for this year is through the roof and they're at capacity. They just cannot do more. They're building out more installations to fulfill all the demand from AMD, from NVIDIA, from all the other players that want their business too, right? But they just cannot sustain the demand right now. They just don't have the supply for it, right? I expect TSMC will say the exact same thing. And as a result, they will be needing more of ASML's machines. But not only that, a new kid on the block, well, not so new, but, you know, kind of getting back into people's good graces. ASML is also expected to benefit from NVIDIA and Intel's $5 billion deal as semiconductor equipment demand increases. French AI firm Mistral as a way for ASML to get closer and closer to the AI world. So that partnership is decent as well. But the Intel deal is decent, right? Maybe they won't have to sell off their foundry business for parts. Maybe NVIDIA and TSMC will actually show them how to design chips and manufacture chips the right way. And maybe the foundry business for Intel is going to get more ASML machines to help them on that journey. It's a long recovery story. Sorry for laughing, Intel investors. I mean, I play the stock as well, so I can't really be laughing, or I'd be laughing at myself. No positions for me on Intel right now, but maybe soon. But yeah, so maybe that's a little bit of an avenue for ASML in the future, but there it is. That's the whole presentation. So softer 2026, but 2027, 2028, good. Long term for the company, guys, this company has an untouchable moat, arguably. China, I mean, you guys can bring up China as much as you want in terms of technological prowess, which is true. They have very good tech on their side. But, you know, industry consensus by experts, not by me, but you guys can ChatGPT this if you don't believe me. China is like half a decade, if not more, behind ASML's technology. And that's if ASML would just stop making new technology, right? The lead is very, very, very wide, right? And you guys know in technology, even a 1 year lead is a lot, right? So, you know, 5, 6, 7 years worth of an advance on China tech is large, very large competitive advantage. Total net sales across logic, memory, installed base management, and also their services. Because don't forget, when they sell these machines to you, they're very cheeky. They say, we sold you these machines, but who is going to service them? Nobody, because nobody knows these machines. They're too complex, right? They're as big as an apartment building. So we obviously got to sell you a service plan. It's kind of like the elevator companies. They do the same thing. We will not sell you an elevator without a service plan because we don't trust anybody around these elevators. You guys shouldn't either. They transport people, right? So obviously we have to service them ourselves. Shout out to the elevator business. Very good business. ASML is the same concept. When they sell you a machine, they are going to sell you the service plan. They make a lot of money from their service revenue, but here's the division of logic versus memory, of course, has been growing. The memory division has been growing. Obviously, this ebbs and flows with the demand for memory. We talked about this so often. A lot of the memory demand, guys, sure, data centers is a little bit, but a lot of it is personal electronics, vehicles, and industrial applications. That whole segment of the semiconductor market has been stuck for the last like 2 years. Names like Texas Instruments, APS decline, right? This is the consumer side of the business, right? As a result, the share price hasn't done much. Qualcomm, onsemi, this whole segment of the semiconductor market, MCHP, this whole segment of the market, and even Microns, this is a data center move, right? Not personal electronics. So ASML, that whole side of the business, what the CEO was saying on the earnings call is this side of the business, personal electronics memory, is starting to see the inflection point, right? So as a result, sales are up and possibly going to be up in 2026 as well, contributing to more and more of a portion of the revenue as opposed to only, large scale data center applications for the other side of their business. So ASML, end of the day, guys, is it a solid company? Yes. Do I have it in my long-term portfolio? Also, yes, because of the competitive advantages, because of the very large moat. But is it a good chance to buy right now at $1,000? Well, here is where I have to say it again, guys. I mean, I was saying it down here for like a year. Let's be honest. I was saying it for a year down here. So you can't blame me. I try. But if, let's just say this is the first time you've ever heard about the company, or maybe the first time you're ever watching the channel. If that's the case, welcome. If it's the first time you're watching or you're seeing the company, I guess welcome to ASML as well. Right now, is it a good buy though? On paper, objectively, not so much. Price to earnings ratio, and I'm using 2026 numbers now because we're deep third quarter. So we have to use 2026 forward multiples, right? 33 on a forward price to earnings metric, 2.39 PEG, free cash yield 2.93. These two metrics are a bit high. The entire time down here at 700, guys, it was so attractive. It was so attractive. Right now, it's just not attractive anymore. If I can somehow find it though, back down at the 800s level, like mid 800s, it's fine. Is it a nibble up here? All right, I'll give it to you. It might just be a little nibble, but is it a full size position? No, the valuation is just not there to warrant a full-size position, in my opinion. That being said, it is a hold for me right now. Phenomenal company, fantastic moat, fantastic competitive advantages all across the board. This company is going nowhere, probably but up in the next few years. It will be bumpy in 2026. It is one of my favorite tech companies in my long-term portfolio, and I will be keeping it for a very long time. But there was a time to buy, and then there's a time to hold, right? You got to differentiate the two, or in terms of the size of the buys. These are big buys down here. These are small little nibble buys because you're not getting the best price. So keep that all in mind when you are doing analysis of companies after earnings. And that wraps up our earnings segment of the discussion today. We might not even have time to do the portfolio update today. I might have to keep it for tomorrow, guys, because we're running like an hour deep and I haven't even gotten into the charts just yet. But that was a lot of juicy info, right, to start off the video. Now, let's move into our technical analysis portion of the video. And we're going to run through these a little bit quickly because not much has changed, but the price action is volatile. So in terms of the SPY, guys, we are now trendless officially because we had the daily uptrend with the higher lows. We flushed the higher lows with Friday's close, and now we are basically trendless. We are waiting for the bulls to either reclaim the highs, which would result in a recapture of a possible daily uptrend like this, or move to the downside. You're back to daily downtrend, the first daily downtrend of its kind in a very long time, guys. Since the April bottoms, we have not set a new daily downtrend. Has to be notable to you. The bulls are trying to save the short-term EMAs, though. Below support, 651 down to about 646, and on the weekly time frames as well. So far has been very nice weekly consolidation, right? Nice little downswing here on the weekly. We haven't lost the weekly time frames. That will be breaching down here, 635. A lot of space to work with. If we do fall a bit further, your first line of defense would be that whole 650 area in line with 12 EMA. No need to speculate, no need to predict. Just wait for the price action to show you what it wants to do. With the high VIX environment right now, it's a great opportunity to be selling puts on your favorite companies, but only companies that have come down a decent amount, right, into nice support regions, which we'll be bringing up over the course of the next few videos as well. On to the QQQs right now, same concept. You are trendless on the QQQs. You lost the daily uptrends. Well, you don't see it so much on the QQQ chart, but you do see it on the futures chart. Clear break of structure right there. So we'll just say the bears did indeed do it. That being said, lost the daily structure and no resumption of the uptrend, no reclaiming of the all-time highs just yet. If you get a breakdown of the daily downtrend, right? Because now it's anybody's game. We're in the middle right now, right? Headlines, et cetera, take your pick, right? Tariff headlines, jobs data headlines, government shutdown headlines, earnings headlines. Take your pick. Any one of those could send us a bit lower. If they do, first fallback range, 581 out of 575. And that would be a nice smooth back test of the 12 EMA, which I'll remind you, the bulls have not lost since the April lows. So that should be the line in the sand level for the larger timeframes right there. And the bulls are still working with a decent amount of space, anything above 561, just looking for a weekly higher low. But you pull back too much, you open up the door for the infamous weekly downtrend and the infamous monthly consolidation phase. The markets are running very hot on the monthly timeframes. You look at the SPY and the QQQ, we are extended from the 12 EMA. So as I was saying in the introduction, guys, right, with the whole bubble narrative, they have the fuel. So don't be surprised if it happens, right? Any catalyst that they want to use at this point is fair game. And what will be the fuel to bring us lower? Well, it'll be the bubble talks. Of course, guys, that's going to send you lower. But at the end of the day, as long as the market still has strong underlying fundamentals, you guys know the drill. Short-term narratives are only narratives. At the end of the day, this market moves on earnings. If earnings are still strong and the consumer is not just completely, dead, left for dead, essentially, with spending and credit and stuff like that, which they're not right now, then eventually these market downturns can be met with new support lows, new monthly higher lows, possibly to resume trend a little bit after they're done consolidating. But I'm not predicting, guys. We're just looking for the catalysts and adapting our trading in the process. Moving on to financials right now. So financials over the course of this week, a little bit mixed, right? Big downswing on Friday, then very nice earnings, which brings us back above our support range, 53.30 down to 52.88. Bit of a tight support range. You can say that financials haven't really been doing much the past 2 months, and I would definitely agree. So the weekly timeframes don't show much, but the bigger support area is this one, 52 down to $50. It's a big level, guys, and that is also your monthly fallback level. You remember on the SPY QQQ, we were talking about these monthly pullback ranges? Financials ones is actually closer, right? They have not pulled. Well, they pulled away decently, right? But we have been consolidating. The bottom end of it, 50, would be the monthly 12 EMA, something that other than this massive tariff sell-off, hasn't been lost or closed under on a monthly candle since 2023. So keep that in mind. This is where the bulls are probably going to play a ton of defense. Sector's not looking too bad. I already gave you guys my favorite plays for the banks, JP Morgan, Goldman Sachs. And you guys know, I've been saying this for weeks and weeks and weeks. Visa. I really like Visa down here, 340 down to 327. Even shout out to MasterCard, building a further position in MasterCard. Not the worst opportunity in my mind. Moving on to healthcare right now. Healthcare pulling back from the highs. You see best what's happening on the weekly time frame. Beautiful weekly upswing here, weekly uptrend, and now just reacting from resistance, which was 148 to 145. The bulls getting rejected right there and going for a bit of a consolidation low. So we'll see when they actually form that one. Right now, right, daily pullback. If they unwind a bit more, daily downtrend, you guys know the drill. We're just going for a bit more weekly consolidation, maybe back into these highs, maybe back into the EMAs. But I do believe that any further consolidation on healthcare will be another decent reload opportunity to once again attack these higher regions right there in terms of the resistance range. Sure, the buying opportunities are not as juicy as they were back here, but it could represent a very nice new entry opportunity around that 140 range. So healthcare, not looking too bad. We will see how the monthly candle closes. The bulls are really trying to put some space between us and those lows to eventually reverse the monthly, because this is still one sector of the market that is still in a monthly downtrend. We still haven't reversed into a monthly downtrend. It's one of the last ones that still is not in a monthly uptrend, so keep that in mind. Moving on to the SMH right now, semiconductors still remain very strong. I'll remind you, earnings on deck for tomorrow are going to be, oops, that's the bigger chart, TSMC. TSMC is going to be a very big one for semiconductors tomorrow. And you know what's funny? Across all these semiconductor names that have been booming, the one that makes all of this possible, NVIDIA, has just been doing a whole lot of nothing. Isn't that funny? In the past like 3-4 months, the one company that's arguably made all of this possible is just not doing anything, while the rest of the market kind of runs ahead of it. So I find that quite humorous, but I digress. Moving on, a bit of trendless action here on the SMH, right? Very choppy price action with the Friday close. It was a bit of a daily downtrend. The bulls trying their best to recapture, but it's going to be a break of either or level, guys. 346 to the upside or 324 to the downside for a resumption of the uptrend, or just a crack of the lows and go into weekly consolidation. If you go into weekly consolidation, pretty sure that's what most people are worried about at this point in time. Weekly overbought conditions. Everybody knows that the semiconductor narrative is playing out very rich right now. A lot of companies printing the highs consistently. If you do come back here, maybe come back to the 12 EMA. 310 would be a logical area there. And on the SOXX, if you guys like that a bit better, 12 EMA is down here at about 261. Tons of space for some very healthy pullbacks in the event that that is what needs to happen in the markets. On to the Russell. The Russell up 0.98% today. Very strong push. The Russell recovering more. Actually, one of the only sectors. Look at all these sectors, right? SPY, not above Friday's highs. QQQ's not above Friday's highs. XLF, not above, or rather, not above the recent highs there. XLV, no, not getting it either. SMH, no. But the Russell, surprising everybody. Growth, really starting to pull ahead, right? Now, not all small and mid caps are in bubble territory. Matter of fact, the Russell is just now breaking out from prior highs established late 2024 or 2021. So is this one in bubble territory? Probably not, but it's been a very nice 6-7 month rally off the lows right now. If you get any extended pullback in the markets, which translates to a pullback in the Russell, you're going right back down here. 230 down to 225 would be the logical area. Just going for the monthly breakout retest. This would be a very nice monthly cup and handle pattern formation, right? Like we saw on good old AMD. So that could be somewhat interesting for IWM if it does happen. I don't believe that growth stocks, especially as measured by the Russell, are in that much of a bubble territory. Maybe some aspects, some niches of that market, but definitely not everything. I'll remind you that the Russell is not only a bunch of profitless tech stocks, it's also a whole bunch of industrial names, healthcare names, financial names as well. So keep all of that in mind. In terms of positioning on the Russell, I was very clear in stating it back here when we got the breakout. The only way to logically position on the Russell back here was doing, if you wanted to play this one, a bit here and then a bit more waiting for the pullback. That has not changed. It would be a bit here and then waiting for the pullback, but constantly committing more and more on the rally rise is not the best way to build out a position, right? You'd want to build some in a general level and then say, you know what? I'm going to wait for a pullback. If it doesn't come, I guess that's just everything that I can actually put into the trade, because right now it's getting a little bit late. Not late in relation to the next 2 years, but late in relation to the uniform move that's happened right now, right? Not much pullbacks to be had. We were hoping for one after last Friday, but they didn't give it to us. Rally back towards the highs. If they do give it to us, it'll happen fast. You guys know how fast these pullbacks can happen, right? So pay attention to them. That being said, that's everything for your overall market rundown. Hopefully you enjoyed that. The VIX providing some very nice opportunities to sell some puts in the market right now, trading at 20. So obviously, more volatility in the markets right now. Why? Well, I mean, take your pick. There's this, there's China, there's this, right? There's the government shutdown, there's this, there's the AI bubble stuff, right? Take your pick. Everything's on the table right now for volatility, right? That being said, phenomenal opportunity to sell some put options. And if another catalyst, right, comes to be, or rather happens in the market, right, and we move even higher, it's an even better opportunity to sell some puts in the market. But you know what's funny? A lot of the companies that pulled back the most are companies that are still trading very, very high right now. We haven't had big pullbacks in some of the companies that we might actually want to trade. Like a lot of the big tech companies, right, haven't pulled back that much from recent highs. Maybe with more of a sharp uptick on the VIX, maybe you'll start to see a bit more action here on some companies that you'd be more interested in playing rather than chasing the same names that keep printing the highs, right? Like, what are we going to do? I'll just give you an example, right? Like, so let's say Oklo, right? Oklo, like a day, like, you know, like let's say tomorrow has like a 10% decline. Well, what are we going to do, guys? Where's it pulling back from, right? It's pulling back from there to there. Where are you? You're still all the way up here, right? Does it make sense? No. So obviously you're going to need more pullbacks than that. So those are not the names I'm looking for on pullbacks, but we'll talk about that more when we go through our individual list towards the end of the video. Moving on to other things that concern us, talking about, I guess we'll bring up yields a little bit. So yields moving down. We had that news release from the Fed right here, the balance sheet runoff, meaning that they're done selling bonds in the market. So that was good. Yields responded well to that. 10 and 20-year yields coming down on that. And we've now claimed like a big level, right? This 4.2 on the 10-year, decent weekly downturn right now for yields. We'll see if that actually persists in the market. Moving on further, 20-year yields down as well, coming to attack the 4.5 region on the 20 and the 4%, the infamous 4% region on the 10-year. Maybe mortgages are finally going to come down as well. In terms of the bonds still struggling with this infamous $90 to $93 area of resistance. If you smash through that, next target for me over the next 9 to 12 months, it may not happen right away. It may be slow and methodical, just like bonds always are. But the next price target, guys, for appreciation, 97 to $100. That would be my final take profit target for any call options that we were able to build in this lower location right there. The first take profit target is right here. So for all those people that were building bonds down here, this is take profit area number 1. This would be take profit area number 2. But just keep in mind, bonds move very slow. Moving on to gold. Gold, the new, this is just trading like Palantir, right? This rally on gold, guys, is as big as 1979. I'm sure you guys remember the good old gold rally of 1979. I remember it as if it was yesterday, right? A whole 12 years before I was born. I remember it like it was just yesterday, right? Oh, I remember how people were feeling back then. It reminds me so much of back then. I'm just kidding, of course. Incredibly difficult to touch gold all the way up here, guys. We talked about this several times in the most recent few weeks, right? Overbought on everything, absolutely everything. 3-month time frame, almost 90 RSI. This is like, peak 2011 you'd have to go back to. Then it really ran hot as well. But also peak 1980, 1979. Monthly time frame. This one is even worse. 92 on the RSI. When did it ever get that high? Peak 1979. Then you have to go back to 1973 to find similar short-term RSI peaks like that. Weekly conditions, overbought, 85 on the RSI. You guys are getting the point right now. Daily, oscillating between 85, 86 RSI. So, is it a good idea to be buying gold up here? I don't know. Depends how greedy you guys want to be, right? If you guys are feeling super greedy, there's a way to play this, right? You can possibly play them with pullbacks of the 12 EMA. As you can see, whenever gold pulls back close to the 12 EMA, sometimes it represents a decent buying opportunity. Sometimes it doesn't always get there, but what it does do is it rides, right, this 26 on the 4-hour pretty well. So when you find it pulling back into the 26, which oftentimes is almost the 12 EMA, that is when you can look for a bit of shorter term time frame reversals to happen, right? Recaptures of the hourly time frames. When you get the hourly uptrend recaptures, such as, get the big flushes, then they recapture the hourly uptrend, that is when you can possibly enter the swing trade longs with the stop loss below the most recent low and go for an expansion leg, right? But just buying gold blindly here, saying, oh, I'm going to buy this. I'm going to buy this here for the long term. Of course, that's what everybody says when they buy something super high, right? Because you don't want to justify the purchase saying, I'm only going for incremental dollars, even though I know I'm late. No. Obviously, we're buying it for the long term if we're buying it up here, because that's the only reason that makes sense to buy it up here, right? I know, guys, trust me. I know everything, man. Don't try to hide things from me, right? Is it a good risk to reward proposition to buy gold up here? Arguably, no. But we'll have a bigger discussion on gold. I don't have the time to do it today. A whole bunch of central bank shenanigans going on right now. It's the whole tariff situation from earlier in April, whereby you saw central banks pivoting away from US dollar bonds as their reserves more towards gold. I'll show you guys some charts maybe tomorrow or Friday's video. We'll do a bigger analysis on gold, but this is the big money move, right? A very, very big move by big money. But is it a good proposition to follow big money all the way up here? Very debatable, right? The last time to do it was down here, and I was very vocal about doing it down here. This is your expansion leg. Buying it up here is very risky and extremely greedy. I'm not saying it's not going to work, but it's an extremely greedy trade. If you are taking this long up here, you are agreeing that you are being a very greedy person, that you are fine with the risks as such, right? Meaning, if you take a long up here, and then it just goes down for weekly consolidation, well, you better get ready to be a community member, right? Because that's what you'll be telling yourself. You bought it up here, it goes into weekly consolidation. Oh, it's fine, I'll just hold it for the long term. Well, I hope you say that same thing when it does come down, right? Moving on to Bitcoin right now. Bitcoin down about 1.85%. Unfortunately, Bitcoin, after the Friday drop, unwinding the entire daily push. Now back down to daily downtrend, lower highs being set, and we are looking for a revisit of the lows, possibly around the 200-day EMA 107 and down towards our big support area 107.5 down to about 100,000. This is the same area of support that we were playing off of for the last couple of months, right? At the end of the day, the daily and weekly price action is going to look very choppy, right? Liquidation breaks all over the board back here, of course. People might be confused, but you know what you shouldn't be confused by? The monthly time frames. Monthly is looking healthy, right? Nice monthly uptrend with a lot of space. Even if you give back this entire move, you cracked 125, you gave it all back. If you dive back down to the $100,000 range, you're just looking for a new monthly higher low. The bulls are working with a lot of space. Higher time frames hold the key for Bitcoin, in my opinion. Anything around $100,000 should be a decent area to possibly be loading up some more positions. I will be a buyer of Bitcoin as I was the past few months. If you get some dips around 107 down to 100, selling some put options on my favorite Bitcoin assets down there and or accumulating more Bitcoin. That would be my favorite bet. Ethereum, same concept. Big liquidation breaks last week on the Friday session, of course. Huge, as a matter of fact, unwinding the entire bull move, engulfing, and now possibly looking for a little bit more. So short-term charts, not looking the best. Weekly downtrend, somewhat in motion now as well. Testing support 4,000 at about 3,700. At the end of the day, monthly time frame should show you guys the clearest picture. If you lose this area off of any further market weakness, you might be heading down to the lower area, 3,300, right? At the end of the day, what are they going for here? You're going for the monthly breakout and retest. If they cannot hold this one, you might have to pull back a little bit lower. That would not be the most awkward move for Ethereum, though. That, at the end of the day, would be a 50% retracement. Not the worst. It would be a deep retracement, but the bulls still have a lot of opportunity and can get the momentum back to give that extra leg on Ethereum. I'm not saying it's going down there. I'm just saying if it does go down there, I'd be a buyer. The first area for buys would be here in this support range. The second accumulation zone is here. And then you are playing for the longer term expansion thesis, the stable coin thesis, the Tom Lee thesis for the banks, et cetera, et cetera, et cetera, the real world asset thesis, et cetera, et cetera, et cetera. You guys know me. I know all about the Ethereum trade. I'm just trying to bring some light on that whole segment of the market. That's everything for your crypto breakdown. Now let's dive into our big tech names, shall we? And I don't think I'm going to have time, guys, to do two things today. Basically, the biggest gainers and losers of the day section, it's an hour and 15 in the video. I'll cover these big tech names, but my cutoff for these videos is an hour and 30 minutes. I know some of you guys wouldn't mind longer, but that's my cutoff for the algorithm, but also just, you know, for people's time as well. Tomorrow, I promise, we will do the biggest gainers and losers section. I'll cover a lot of charts tomorrow because tomorrow we won't have that many news events to go over. At least I don't think so. And we only have one earnings to go over as well, TSMC. So tomorrow I'll spend a whole lot more time on the biggest gainers and losers. We'll go over a ton of charts outside of this list. And I'll go over my portfolio as well and how I'm positioning in this market, et cetera, et cetera, et cetera. We'll do a lot more of that tomorrow and Friday, I promise. But today, we're probably only going to have the time to get through this big tech list. So that being said, let's get through it right now. So Apple, nothing has changed on Apple, right? Yes, we lost the overhead region right here at 255, but we knew that was always a point of contention, right? It was either new all-time highs, which the bulls were not able to do, or weekly consolidation. With Friday's big move down, well, it looks like it's going to be weekly consolidation. Weekly consolidation is not the worst thing, especially in the context of a weekly uptrend. If you move any lower on Apple, you're coming right back down here, 237 to 225, your next support area and your weekly 12 EMA. Not a bad location if we do come down there to be looking to sell some put options, especially with that heightened volatility. But right now, in the middle of nowhere, midway between support and the all-time highs, tough for me to do a trade up there. That being said, Apple earnings should be decent. If you guys look, man, I mean, I don't know about you guys, but I was in a couple places in Asia. iPhones sold out everywhere. Here in Canada, can't find them either. At Costco or some other big box retailers, tough to find them. And even if I want to order them on the Apple website, it's a 4-week wait for all the iPhones. So very good performance by Apple in this recent edition of their iPhones. Moving on to AMD, guys. AMD, strong, 9.4%. AMD has been all over the place, very volatile, but one thing's for sure, right? Very, very solid stock. The reason it was up today so much was, of course, they signed a new deal with Oracle, right, for the 50,000 MI450s, but also they got a huge, I can't find it real quick, but they got a huge price target upgrade from one analyst from 185 to like 330. And everybody currently acknowledging right now that maybe we underappreciated AMD. Shout out to us on the channel. We said that here, and we said it again back here when we were commenting on this might just be a very nice cup and handle. You know, people were saying, well, AMD's not doing anything, man. Other semis are rallying so much. It's not doing anything. It's just consolidating. I was saying, I'm doing short puts and I'm building leap positions. You guys do you. And now you got the big move higher on AMD. It might not have happened in one single open eye candle, but it probably would have happened progressively over time. Let's be honest here, right? The company was relatively cheap down there at the 160, 150 range and had phenomenal growth prospects in the future, which, by the way, it still has. This company is running on fundamentals, not on only hype. Huge expansion on EPS, huge expansion on revenue. I like it a lot. But do I like it up here at 240? Guys, right? There's a time to buy, and there's a time to just watch your buys perform very well. This is the time for AMD on me right now. It is very tough to buy this stock up here. So congratulations if you're in. If you're not in, you are late. Can you still make money even though you're late? Maybe, but you'd have to set a stop loss below this guy right here, 213. Because if you lose that, you lose the daily uptrend. That invalidates your weekly push, and you might just be going into weekly consolidation. If that happens, it's probably because the broader market is consolidating too. So keep that in mind for AMD. Moving on to Amazon right now. Amazon down 0.38. This one just cannot seem to catch a break. But that being said, is Amazon's forward fundamentals, do they look good? How's the company doing right now? I don't know. Are all the analyst price targets well above? Seem to be. What about the strong buys and buys from the analysts? Seem to be okay. What about EPS expansion? Oh, they're doubling EPS in the next 4 years. Okay, cool. Oh, they're going to make almost $1 trillion in revenue by 2028. First company to ever do so. All right. Amazon's lines of businesses are firing on full cylinders. You know what this reminds me of? This reminds me of Microsoft last year when it was doing nothing. And I was saying, yeah, it's a good accumulation zone for Microsoft. They'll probably come back to outperformance soon. It reminds me of Google doing nothing for so long, out of favor, sentiment-wise, for so long. This reminds me of those two same things. But over and above that, it is also just a monthly higher low. Looking to backtest maybe this area right here, monthly 12 EMA, which is something that the bulls often use in a bull market, right? You can go back in past history and see that Amazon has made good work out of that 12 EMA when we come down into it. So am I still a fan of buying Amazon shares down here? You guys should know the answer to that. And am I still a fan of selling some put options on Amazon down here? 210 down to 200. You guys should know that. It's been featured in my top 5 options weekly list for the past 4 weeks in a row. And, you know, we may as well make the most of it while it's here, because when they run, and we can't play them anymore. I was playing Google a ton this entire time. I can't play Google on the wheel anymore, right? I was playing Microsoft a ton, an absolute ton this entire time here. I can't play Microsoft anymore. And so many companies are like that too. I was playing AMD an absolute ton here, a lot down here as well, but recently a ton here. I can't play AMD on the wheel anymore. So Amazon, you know, one of the last remaining stocks that is currently underperforming the market. It's crazy to think that Amazon is down year to date. I mean, so is Apple. And shout out to Apple as well. Same concept on Apple. We were playing the heck out of Apple back here. And lastly here, I can't play Apple anymore all the way up here. So I may as well take advantage of Amazon while it's here, because it's a company with improving fundamentals that the share price hasn't moved since last year. So keep that in mind. Moving on to Google right now. Speaking of things that have rallied a significant amount, Google's looking very strong. But Google for me right now is a hold or a small nibble. Daily downtrend, nice engulfing move by the bulls. If they want to recapture, you got to reset the uptrend. The weekly, not looking bad. If you recapture that uptrend, right, you know that your weekly higher lows are set. And you were looking for maybe another leg of weekly expansion. To where, you might ask? Well, I don't know. It's a blue sky breakout. Psychological numbers maybe. 275 and 300 would be your next profit targets right there. Is the stock currently overvalued right now at 250? Debatable, right? Trading at a 1.7 peg ratio roughly. I mean, I'll do it real quick. I did it at 225. Let me just update it for 250 for you guys, just so it's not confusing. So 250 by 960, which is your EPS. It's a 26.4 for 2025. For 2026, it's going to be even lower, right? So 26.04, I'll include the 0.04 just so nobody screams at me. And then divided by the EPS growth rate, you're looking at 15%, 1.73 peg. So, you know, mental math, I wasn't off by so much. Is it still decent up here? I'm not going to lie, guys. The valuation is still fair. Is it as attractive as when we were buying it heavily in this whole region under 200? No. But does it still make sense to buy up here? I think the answer is yes. But super heavy as we were back there? No. But can it still be a component of some nibbles with some DCAs for like a weekly or monthly DCA plan that you guys might do with your paychecks? Sure. Yeah, I wouldn't mind that. Moving on to Meta right now. Meta up about 1.26%. And this is also one of the more interesting buys in the market, in my opinion. Beautiful backtest of support and giving back the entire earnings push. Meta has not done anything but go down since last earnings, right? The big earnings push, then barely new highs with a downward bias. That being said, 710 down to about 680 is your line of defense for the bulls right now. Weekly downtrend. This is one of your only big tech stocks other than Amazon, right? Amazon as well kind of hit the weekly downtrend metric, but Meta, weekly downtrend. What does a weekly downtrend mean? Is it the end of the world? No, just means you're into monthly consolidation, something very normal for a lot of these stocks. And monthly consolidation doesn't come around that often. And when it does on one of your favorite companies, you may as well make the most of it and take advantage of it. You guys know that I was saying if Meta comes, I was saying it up here. I was saying Meta's a nibble 730. But if it comes down to 700, I'll start buying it a bit more heavily. And I have been buying it a bit more heavily and even engaging in some swing trades down here in the low 700 region. So Meta's looking very good, but you got to use the longer time frames for that. The bottom end of this 680 would line up perfectly with the 12 EMA. And Meta just loves riding this 12 EMA in the context of bull markets, unless you get a COVID scare or the 2018 scare or the 2022 disaster, of course, or the tariff scare, right? Unless you get bigger broad market pullbacks, 12 EMA is a nice location to possibly be building some positions. So expect me to be building more positions from that 700 down to 680. Meta looking very strong, good fundamentals for 2026. Moving on to Microsoft right now. Oh, only 6 minutes. So I'll try to cover these quickly. Microsoft just trapped in this range. Let me extend my very crooked lines right now. Let me make them a bit straighter, right? Back in the good old magnet range, kind of like Netflix, our next stock, right? Microsoft doing nothing. Price action, very unclear. They tried to go for the daily uptrend breakout, right? They had it, they lost it. We'll see if they get it back. The weekly, all over the place as well. Very tight range of consolidation. Tough to know which one this will break. In my opinion, it's going to break in the direction of the market, right? SPY goes down, Microsoft's coming down. SPY goes up, the bias is indeed up, possibly for a recapture of the weekly uptrend. The monthly time frame as well shows just a bit of consolidation on any further drops. You guys know me, Microsoft would be a decent buy down here, 470, 480. I've been saying it for a while, right? And sometimes they do pull back to my regions. I was waiting for Meta to pull back to the 12. It's almost there. It doesn't mean that I have to wait until it's there to buy. It just means that I want to buy closer to this than all the way up here, right? So that being said, I'll be patient for Microsoft. If it comes down and picks me up, fine. If not, I have more than enough shares that I bought down here for this company. As right now, above 500, the valuation is just a little bit too steep for me on Microsoft. On to Netflix right now. Netflix as well, coming back to the magnet range. 1200 down to 1185. I don't know how many times I've said those two numbers in the last 2 months, but I'm kind of getting sick of it. So I hope they change ranges, either up or down. So that being said, price action very unclear as well. The bulls are trying for something. We'll see if they can get it done or if they just do another false breakout and break back down to the range. Weekly price action, very unclear as well. At the end of the day, this is just very extended monthly consolidation. Sideways consolidation though, waiting for the 12 EMA to catch up, right? So there's two ways to come down to the 12 EMA. Either you just flush down into it, which is one way, or you can just consolidate sideways and wait for the price action to catch up to the stock, right? This is sometimes what Palantir does a lot, and Netflix kind of doing that as well. Netflix for me, 1100s, when I see an 1100 handle, 1100s down to like 1,000, I'm a decent fan of buying some Netflix down there because then the company is trading around a $500 billion cap. And the forward price target, or the forward cap target by management, is $1 trillion by 2030. So that's a double in 5 years. Not too bad for a mega cap stock. Moving on to NVIDIA right now, the good old AI play that just doesn't seem to sustain rallies, even though the rest of the market does. NVIDIA losing the daily uptrend. So this has to be notable to you, right? Big loss of the daily uptrend. It started last Friday and it just continues into today. They are barely holding on to the 180 support level. These guys right here, resistance, break, support again, but barely. If they lose it, because that's everybody's concern, where are we going, guys? Right back down here, 170 to 165, the same area that held up the market during the September consolidation. Still a weekly uptrend, but we might be getting a bit tired up here, right? On the monthly time frame, even if we do get a bit more tired, well, maybe you just might see some healthy monthly consolidation back to the 170, 160 range, which indeed, in my opinion, would be a buying opportunity for NVIDIA. You guys know the drill. At 175, NVIDIA is currently trading for a 1.71 peg, which is really not that bad at all, guys. It's trading for as expensive as Google on a peg ratio basis, right? And forward price to earnings as well, right? I have the 2025 EPS right here. I know it says 39 for 2025, but if you take 2026, the peg encompasses through 2027. So that's why I don't pay too much attention to this number. But if you really want me to do it on screen right now, I'll do it for you guys, right? Forward EPS for 2026 is a lot higher, 6.46, right? So if you just do this, right? Let's say 175 divided by 6.46, there it is, 27 forward price to earnings multiple, which is very fair for NVIDIA and their growth rates right now. So solid company. If we consolidate a bit more, I will be playing it, and I am already playing it. I have some short puts down here, 170 for this Friday, so we'll see what happens. Moving on to Tesla right now. Tesla up 1.38%, bar coding. I think Tesla won't move until their earnings, which is going to be next week, so we'll see what happens. Tesla expected move is about 8%. I don't think we're going to crack new all-time highs before then, but I also don't think we're going to breach this support level, so we may just be trapped in somewhat of an awkward range here between two levels. It's not really support, That's down here, 400 down to 385. And it's not really resistance. That's all the way up here, 460. We might just consolidate until earnings. So I won't be positioning on earnings, or I won't be positioning on Tesla much before earnings. But if for ever which reason we come down after earnings into this area, you could possibly find some swing trade opportunities for some swing trade longs for Tesla, but we will tackle that trade when we come to it. For now, no positioning for me. I'll just wait for those earnings to come out. Moving on to Palantir right now. So Palantir down about 0.07%. Palantir as well doing a whole lot of absolutely nothing, consolidating in this awkward, close to all-time high range. So the bear is building a bit of a ceiling of resistance above in the event that I think Palantir is going to be like Microsoft, right? If the QQQs and the rest of the markets move higher, Palantir will benefit from the upward bias. If they move lower, well, of course, Palantir is not going to do this. If the SPY and QQQ don't go down 3, 4, 5%, will it, right? I know a lot of people would like to believe that, but that's just not the case. Now, concerns on everybody's minds should be the downside. So let's talk about the downside, right? If we roll this over, are we losing much ground? Not really. The bulls are still in a very nice weekly uptrend. It might just be some extended consolidation. Next support range has to be down here, 150 to 139. So the bulls are working with a lot of space right now. If you get some big moves down, quick moves down with a lot of volatility, you'd be surprised. You might be able to find some short puts on Palantir down here. Or if you've been waiting patiently and you wanted to add some shares, who knows? When the volatility kicks in, right? Palantir usually gives some really nice re-entry opportunities towards some of the lows, some of the lower moving averages, right? You guys know the monthly is super extended. It's been extended for a while. It's just begging for a pullback. I'm not saying it will pull back. I'm just saying if it does pull back, you might also see me capitalize on that location. The primary area of interest would, as I said, be that 150 to about 140 level. That's the first line of defense. They tested it back here as well. Moving on to SOFI right now. SOFI was actually up like 4% today. Sadly, they only closed up about 0.57, which is still good, but SOFI has been struggling as well with the higher levels, right? Very unclear price action. Daily up, downtrend, nice engulfing move. You were expecting the bulls to kind of convert. Nope. Friday and then Monday, Tuesday, Wednesday, awkwardness. We will see what happens. The daily is very choppy right now. At the end of the day, this is still just weekly consolidation until the bulls prove to us that they can get a daily uptrend back. That would be a break above the high of last Friday, 29.66. If you do not break that, you cannot say the weekly lows are in and you're going for much higher, right? You are still in the midst of weekly consolidation. And as a result, I'm still a big fan of, with the increase in the VIX, selling some put options down here on good old SOFI. That's the way that I'm trading it. It would just be a very healthy monthly consolidation phase for this stock, which has very good fundamentals around 25. It has a 1.61 peg and a 9 forward price to sales, which is very good for a fintech player, especially when you compare it to some industry peers such as Robinhood. I know they're not exactly the same, but it's a closer comparison than if I were to compare this one to, let's say, I don't know, like AutoZone or something like that. You know what I mean? Moving on to Uber right now. Uber up about 0.29%. That being said, Uber pulling back into support perfectly, 93.40 down to roughly 90.53. So Uber tried to close above $100 so many times. Couldn't get it done though. Weekly timeframes, guys, not looking the best. You could argue that it's a bit of a tightening wedge up here. It's not the prettiest one, right? But usually these do end up sometimes in big bear breaks to the downside. If that does happen on the weekly time frames, just keep in mind what's going to happen there. It's going to be monthly consolidation, right? So beautiful legs of expansion here from Uber. You might just be looking for a bit of monthly consolidation. And if that does happen, I will be very ready for it, especially down here in the lower 80s. If the markets have an overall pullback for whichever rich reason, as I said, take your pick, right? This, not that one. That's bullish. This, the bubble, whatever, right? The jobs reports and Uber comes flushing down. Well, just focus on the fundamentals, right? And at lower than 80, especially lower than 90, closer towards 80, the low 80s, valuation is very decent in relation to Uber's growth on the monthly active users, mobilities, deliveries, everything's going well. Free cash flow, huge amount of buybacks, great revenue and EPS growth. And at $89, stock's a buy. So in the low 80s, it's even more of a buy. And I will be sitting there patiently to get my monthly re-entry trades if they offer them to me. And now lastly, TSM. I mean, we can't say too much about TSM. They have earnings tomorrow, so I guess we'll have to see what happens with that one. I'm expecting good earnings, but keep in mind, the stock has rallied an absolute ton since recent consolidation. It's up 33% since the last area of consolidation. So even if they have ridiculously good earnings, If the stock doesn't go up 1,000,000% tomorrow, just understand why. It's kind of baked in already. So we will see what the price action does. Obviously, if we break a bit higher, guys, blue sky breakout, next target would have to be psychological, 325, 350 thereafter. So we'll see what happens. If we break to the downside, it's going to be Friday's low. It's going to be the point, right? I'm not expecting a earnings disaster, but let's just say crazier things have happened in the markets, right? If they pull an ASML last quarter and we go into weekly consolidation, that's all it should be viewed as. Weekly consolidation after a very big, strong move and weekly overbought conditions. So keep that in mind on TSM. Is TSM a buy up here at $300? Not anymore, guys, right? We were very clear on saying it was a buy here. It was a buy this entire time here. I've been saying TSM has been a buy for like a year and a half now. But there's a point in time where you kind of have to draw the line. And the line is here at $300 per share. The valuation is getting a little bit stretched, in my humble opinion, even for TSM, right? When you come up this high, this fast in weekly overbought conditions, I'm not selling any of my TSM shares. Don't get me wrong. But there's a buy, there's a hold, and there's a sell. It's not a sell for me. TSM is arguably never a sell for me. But it is a hold right now. At worst case conditions, it's a bit of a nibble. But if you guys want me to redo the math for you, right? At 300 divided by 967 in terms of forward EPS, right? It's a 31, which is not that bad in terms of forward, priced earnings. But you're trading closer to a 2 peg than not. Before, it was closer to a 1 peg. 1.4, 1.5, even at 230 was good. Now, it's a bit of a nibble, which you can make the kind of like Google, right? It's the same concept. It's a nibble, but it's not a strong buy for me anymore. That being said, it's one of my favorite semiconductor plays in the entire market and has been for a very long time. And I'm not selling a single share. And that is everything I had for you guys for today's video. As you guys can see the time, right? 1 hour 35. I don't have time for the biggest gainers and losers. I don't have time for the portfolio. I promise we'll be doing a lot of those in Thursdays and Fridays videos. And yes, I will be here, not going anywhere. We are through the sickness. They tried to get me, man. They tried to get me. They tried to keep me down, but you can't keep me down forever, man. So sorry for missing out on those videos, but I'm back with you guys. Hopefully you guys have been doing well in my absence. That being said, that's it for today's video, guys. If you enjoyed the video, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing to the channel if you're new as well. We're almost at 10,000 subscribers, man. It's crazy how far we've come in the 2 years that we've been doing these channels. And I know my videos are not the best for the algorithm, guys. I don't use clickbait titles. I don't cover, in my titles, I don't put the most hype stocks. Like my titles are not Palantir, SOFI, Robinhood. You know what I mean? Like I don't use clickbait titles. The length of my videos are definitely not optimal, but still almost 10,000 of you have found my videos and found them informative enough to subscribe. So thanks to each and every one of you. You make the journey worthwhile every single day that I do make these. And last but not least, if you have any questions, please feel free to leave them down below in the comment section. I'll answer them as soon as possible. I'll see you guys tomorrow after the close, and we'll cover a bunch more charts. I promise. You guys know me. I love covering the charts, but just no time today. Today was a catch-up day. All the headlines, all the earnings. That's it for me. Enjoy the rest of your evening. Get out of here, guys. Love you as always. See you guys tomorrow. Peace.